Hello guys, what's up? I'm back with some valuable content for you. Today we're analyzing the NASDAQ M15 chart. I'll walk you through a live trade, showing you how to manage potential problems, protect your stop loss, and successfully hit your target. Let's dive in. As you can see, the price is forming higher highs and higher lows, indicating a clear uptrend. The last major impulse originated from this price level. Within this impulse, we need to find a demand zone. However, there are no clear zones available. The only potential one was already mitigated by a small wick before the price moved up, leaving no other perfect entry points in this leg. However, at the bottom of this impulse, you'll notice a large wick. This indicates the price swept the liquidity below it before initiating the strong buying momentum. After this liquidity sweep, there's no reason for the price to return to the bottom. The market needs liquidity to move, so it's now likely to tap the nearest demand zone before continuing its upward impulse. This brings us to our opportunity. An equal lows liquidity pool has formed just above our demand zone. For our target, we can look above to the equal highs liquidity pool. So, the complete trade plan is, we are in a bullish trend. Liquidity exists both below, equal lows, and above, equal highs, our position. Our strategy is to wait for the market to collect the lower liquidity, tap our demand zone, and then rally towards the upper liquidity target. Based on this plan, we've placed our buy limit at the demand zone with our target at the liquidity above. While this setup makes our risk-to-reward ratio a bit smaller, the overall bullish momentum gives us the confidence to hold the trade. And there it is. Our target was hit perfectly. This is the power of trading with a smart, structured strategy. Recap and final thoughts. Let's do a quick recap of the key elements. A clear bullish trend, a demand zone preceded by equal lows liquidity, and an equal highs liquidity pool for our target. The price executed our plan perfectly. It swept the lower liquidity, tapped the demand zone, and then broke structure to the upside. If you found this video helpful, please let me know in the comments. Your feedback helps me create more of the content you want to see. Alright, let's break this down step by step. We're going to look at another chart together and see how market structure helps us plan a trade. First, notice how the price has been moving. It's creating higher highs and higher lows. That's what we call a bullish continuation. And what does that mean? Simple. It tells us the market is in a bullish structure, so our main focus should be on looking for buying opportunities. Now, instead of getting lost in the whole chart, let's zoom in near the current price. Right here, we can see the latest break of structure. From this low point, the market made an impulsive move upward. Within that impulse, our job is to identify the demand zone, the area where buyers stepped in strongly. And guess what? This is the demand zone. Plus, if you look closely, you'll see there's also an imbalance here, which makes this zone even more important. So, by reading the structure, spotting the impulsive move and marking the demand zone, we've set the foundation for planning a strong buy trade. Now that we've marked our demand zone, the next step is to build our trade plan. This is where we look at inducements and liquidity to shape our entry, stop loss, and target. If you look closely, you'll notice something important. This leg already had inducement and liquidity has been swept. That's a strong sign. For our target, we can also see another pool of liquidity sitting around the trend line. So, what usually happens? Price will drop, tap into our demand zone, grab those liquidities, including the inducement liquidity, and then push upward with another strong impulsive move. That's the scenario we're preparing for. Here's how we set it up. Place a buy limit at the demand zone. Put the stop loss just below that demand zone to protect ourselves. Set the target at the liquidity level we marked. If you want to be a bit safer, you can even aim slightly higher. And the best part? The risk-to-reward ratio on this setup is looking really solid. So our trade plan is ready. Demand zone entry, tight stop below, target at liquidity, and a good risk-reward is simple, logical, and structured. Alright, let's see how the market actually reacted. Remember, we had our buy limit placed at the demand zone with a solid plan in mind. But as you can see, the price shot up impulsively, without even touching our demand zone and without activating our buy limit. That happens sometimes. While moving up, the market also created another break of structure and collected inducement liquidity along the way. It just kept breaking structure continuously. Now this is where we need to reevaluate. If we look carefully, there's still an unmitigated demand zone sitting perfectly below. And since the overall structure is still bullish, we can treat the recent low as our new reference point. After this impulsive break of structure, that's the low we'll watch. Here's the mistake many traders make. They ignore the fresh demand zones created under that low. But right here, a high-quality demand zone was formed. Why is it high quality? Because it not only broke structure, but also collected liquidity at the same time. That makes it very powerful. So here's the updated plan. Place the buy limit at this new demand zone. Keep the stop loss in the same place. Adjust the target to the recent high. What will likely happen is this. Price will pull back, collect liquidities along the way, tap into our refined demand zone, and then continue the bullish impulse. So even though the first setup was missed, by reevaluating structure and spotting the higher quality demand zone, we're still aligned with the trend and ready for the next move. Alright, let's move forward and see how our revised trade played out. This time, our liquidity level was marked correctly. When price moved, it tapped right into our entry, and guess what? Our target was also hit perfectly. That was a clean, amazing trade. Simple structure, solid plan, and a successful outcome. But here's something important we need to talk about. A trap that catches many traders. It's called the false change of character. See, many people think the market has made a new low. Since price gave a pullback and broke a minor structure, they assume this is a change of character and immediately switch to a sell-side mindset. They mark a supply zone, place a stop loss above it, and aim for targets at the lower levels. But what usually happens? The market takes out their stop loss and they end up in a losing trade. Why does this happen? Because they didn't draw the market structure correctly. The truth is, the overall trend is still bullish. Yes, the price broke a low and tricked traders into thinking it was a change of character. But at the same time, it had already created a strong break of structure upward, forming a high-quality demand zone. That demand zone also collected liquidity from inducements at the lows. This false move is designed to trap traders. It sweeps liquidity, shows a fake change of character, and makes people sell. But instead of price going down, it reverses back up. And all those sellers, they just became liquidity. So, what's the lesson here? Always read the structure correctly, spot the real demand and supply zones, and never fall for false change of character traps. And with that, we've covered how to plan a trade, avoid traps, and use structure and liquidity the right way. I hope this breakdown gave you clarity and confidence in analyzing the charts. If you found value in this, make sure to like, share, and subscribe. I'll keep bringing you more practical, no-fluff trading lessons. Help me reach 100 likes, and I'll bring you a new strategy or a more advanced version of this one. Thanks for watching, and I'll see you in the next one.